Okay, and welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for Chapter 10, the Group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. The thought just popped into my head real quick. Understanding isn't about reading it once. Right now, currently, I am working on some math on my own personal time, and I'm struggling with the concepts. I'm trying to put them together, right? But what I know is that when I go over it again and again and again, and every time I do a new problem, do a new situation, that adds to my experience, so that when I go back and read the theory aspect of it again, it starts to make a little bit more sense. Maybe it doesn't make complete sense, but I make inroads into the understanding of it. All right. So just realize that. Maybe I should add to this slide that you need to go over it again and again. All right. And eventually, if you do, you do problems, you see the solutions, you can relate the theory behind it, and then all of a sudden things start to click into place, and that's how you understand. Okay. Maybe I should add that to the slide because the application aspect is one thing, but you do need to go over things again and again sometimes. Right? That's just a little spiel. Right, so the next problem. All right, accounting for various stockholders' equity transactions. Right, what I'm going to do here, it says complete the following selected transactions, journalize the record the transactions in the journal. So I'm going to write the transactions down here. I'll pause the video and then erase them. Okay. And if for some reason I have to go back to a previous one, well, then I'll rely upon the solution, what's in the solution manual, or if you've copied it down, you'll be able to, or you've written it yourself, you'll be able to go back to your previous journal entry if you need that information. So on 1.6, it says here, declare the cash dividend on the 9,000 shares of $4.25 no par preferred stock outstanding. Declared a 60-cent per share dividend on the 14,000 shares of common stock outstanding. The date of record is January 17th, and the payment date is the 20th. Okay, so we're going to end up debiting retained earnings, but we don't know how much that is because we have to figure out the cash dividend for the preferred and the cash dividend for the common stock. So I have to credit the dividend payable for preferred and credit my dividend payable for common. And those amounts will be the amount that I'm going to have for my from my retained earnings for the payment of dividend, because we're declaring, we haven't paid it out yet, so it'll be a liability. All right, so for preferred, okay, preferred I have 9,000 shares at $4.25. So 9,000 at $4.25 gives me $38,250. $38,250. Then we have 60 cent per share dividend on 14,000 shares of common stock. So if I have 14,000 shares at 60 cents, okay, that gives me $8,400. Now the thought just occurred to me, if you watched the previous exercise, you did the previous exercise, I had, or was it the one before? Yeah, it was the one before, 56, about the cumulative and non-cumulative. I had said in the beginning, understand the overall concept and apply it to particular situations. Well, in this situation here, we didn't go through the same things that we did the gyrations that we did in problem 10-56. Here, it's just, when they're declaring the cash dividend, they're just saying this is how much preferred gets and this is how much common gets, and it's just that simple. We're not looking at any cumulative or non-cumulative, so we don't have to go through those gyrations, all right? But to know how much, so to get retained earnings, we add the 38,250 plus the 8,400, and that gives us 46,650. So 46,650 is the debit to retained earnings. Okay, so just realize that you're looking at paying a dividend here, but it all depends upon the situation, okay, as to how much each the preferred or the common gets, right? So pause the video as I'm going to erase this journal entry. All right, so that's the declaration. And again, the more of these you do, if you understand if you have an idea of the overall concepts, the more of these that you do and you go back and revisit the theory, the easier it is to understand and then apply as new situations come up. And so now it's 120, January 20th, and it says paid the cash dividends from the previous transaction. Okay, so since we credited our dividend payables, we're going to now debit the dividend payable preferred, and that was in the amount of 38,250, and we're going to debit the dividend payable common for the 8,400, and we're paying it out, so we're going to credit our cash for the 46,650. Okay, so that's that journal entry. Pause the video. I'm going to erase it. Okay, here, let's see here. All right, so on 321, it says here, we split the common stock 2-for-1 by calling in the 14,000 shares of $10 par common stock and issuing new stock in its place. Okay, so when we split a stock, there's no journal entry required, so no entry. Right? We wouldn't even write that in our books. We wouldn't write that in our journal. There's just no journal entry when you're splitting a stock, because all you're doing is you're cutting the par in half and doubling the number of shares. Okay, I mean, you probably in your journal you would make a notation that that's what you're going to do. I mean, that's what you're doing, all right, and put it in your journal. But there's no real journal entry that you're going to quote unquote post to general ledger accounts, all right? So on 418, excuse me, declare and distributed a 15% stock dividend on the common stock. The market value of the common stock was $32 per share. Okay. So on March 21st, we split the common stock 2-for-1. Well, if we had 14,000 shares and we're splitting it 2-for-1, that means we have the 14,000 shares times 2 gives us now 28,000 shares of common stock. Okay. So we're declaring and distributing a 15% stock dividend. Now it's a stock dividend, okay? So we're going to debit our retained earnings because we're taking the money out of retained earnings. The question is how much? Well, if I have 28,000 shares and it's a 15% dividend, okay, and the market value of those shares is $32, that gives us $134,400. So I'm going to debit retained earnings for $134,400. Then I'm going to credit my common stock because this is a stock dividend, okay? We're going to create additional shares of stock. So I'm going to credit common stock, all right? And the amount of that stock is going to be 28,000 times the 15% of the stock dividend, but the par value is now par value previously. Let's see here. Shares a comma data record. Let's see here. Think about this. Where's my? Oh, okay. Split common stock 2-for-1 by calling in the 14,000 shares of $10 par. Well, our 14,000 shares now becomes $28 a share, and our $10 par now becomes $5 a share. We cut the par value in half, and we double the number of shares. So our par value is 5 now, so 28,000 times the 15% stock dividend times the new par value of $5 is $21,000. So I'm going to credit common stock for 21,000, and the difference between the two is my paid-in capital in excess of par. Right, the difference between 134.4 and 21,000 is $113,400. Right? So that's my journal entry for April 18th. So pause the video and write that down. And so I'm going to erase it here. All right. Okay, so now June 18th, we purchased 1,400 shares of common stock, of Treasury common stock at $33 a share. Right. So we're going to credit our cash because we're buying the shares. Okay. And we're buying 1,400 shares at $33 a share. So that comes out to $46,200. And that is a debit to our treasury stock for $46,200. Okay, so pause the video, and I'm going to erase that transaction. Okay, so I'm going to leave the 46,200 up right here because I know we're going to, it says here on 12/22 we're going to sell 600 shares of common stock at $38 per share, right? So if we're selling it back into the marketplace, that means we're getting cash for it. So if we have 600 shares at $38 a share, that's $22,800. So debit cash for $22,800. And of course, we're going to have to credit our treasury stock, right? Treasury stock common. Now, the treasury stock was at $33 a share, right? So 600 shares at $33 a share is $19,800. And of course, the difference between the two is paid in capital from the treasury stock. And the difference is $3,000. Okay, so debits have to equal credits, subtract one from the other, and that's how we back into the paid in capital. Now notice that we could have gone and did it a different way, and this is just, I mean we finished the exercise, but to get this paid in capital, we could have taken the $38 what we're selling it at, and the par was $33, so that's a difference of $5 is paid in capital, times the 600 shares is $3,000. So that's the other way of getting the paid in capital. But notice we have extra steps, things like this. It's just easier to quote unquote back into the paid in capital amount. Right? Watch the theory videos again if you didn't get that. Right? And with that, if you have any additional questions, telephone and speak with an instructor.